Trust me, Aisha, feeble start is not bad. Imagine on Monday morning what were we staring at? A spike in crude, FI selling, and fear of a trade war with a huge emphasis on inflation from Reserve Bank of India. In that context, if you're not cracking and if you're not crashing, I think it's a victory for the bulls. The sentiment is not such that you should expect pleasant days of smooth selling. The water will be rough, the weather is choppy, and you could see a lot of mid-air turbulence. And the fact that you're not crash landing, I would say it's a victory for the bulls. With that same factor, 8,000-9,000 crore from SIP investors and about 10,000-11,000 crore from foreign institutional investors. Net 10 to 15,000 crore of liquidity is the one which is making all the magic. But how long will this one-trick pony continue? I mean, like I said, the underlying terrain is rocky, the macros are shaky, and micros are still in a slumber. So can markets really afford to ignore what is going in the real world? Can markets continue to hide under this entire veil of liquidity? Mahesh, can't complain. Only fund managers are complaining this year because the benchmarks are finding it difficult to beat the benchmark because only 10-15 stocks are outperforming.
Yes.
How long do you think this disconnect will continue, A? And B, how long do you think the concentrated positions which are ignoring the underlying economic reality will be able to ignore them?
I think this trend has now continued for quite some time. It's almost 1.5 years. We have seen this kind of a divergence. And it's primarily because of the fact that, the broader market, many parts of the economy are not doing that well. So there is concentration on a few companies where there is some kind of earnings visibility. I think this trend, it's reached a level where probably it's suggesting that we should see some convergence. We saw that in the last 1.5 months. Okay, there has been some movement in the broader market. We saw the other indices like the mid-cap index starting to relatively outperform a bit. But it's still early days, I would say. I think unless the broader economic growth starts to improve, it's once you get a feeling that the GDP growth slowdown, what we have seen, has bottomed out, then you will see other sectors of the economy slowly starting to participate. And then where you will have options for investors to look at some of the other sectors, not just the top 10, 12 companies, but a lot of the other companies where the valuations are attractive. It's a question about growth visibility in some of these space. Once that starts to emerge, I would see that the breadth will improve and money will start to move away from some of these highly priced stocks which has been chasing into some of the other names.
Will the growth only get delayed, Mahesh? Because just when it appeared that the macros were good and micros were bottoming out, we got a print on inflation.
Right.
We got uptick in crude.
Right.
And we got Reserve Bank of India which has said that, look, I cannot cut rates. It's for banks to figure out how they would transmit. So we are in a situation where macros are poor, where micros are bad and macros have become poor.
Unfortunately, fingers crossed in that global markets are doing okay. And I think that is a big factor while we're stalling and not falling.
I would say that macros are still not really deteriorated too much. So on the macro, if you look at the global macro, there is enough liquidity. Okay, there is financial easing which is there, and that is actually driving to some extent risk appetite. We've seen money moving into risk asset class, and that's the reason why money has come in. It's also come in a lot of companies which has in distress, right? So a lot of distressed funds are actually looking at opportunities in the market, both in the infrastructure side, also on the NBFC front. So I think that is kind of helping for a lot of Indian companies to deleverage at this point in time. At the same time, I think global growth also, we've seen some improvement in the global PMI indicators because of the liquidity. I think that drives growth with a lag, and that is likely to improve. So on the domestic side, I think the exports could see some kind of a pickup in the coming months. And while inflation has moved up a bit, oil prices slightly higher, I don't see there is enough room for oil prices to go up further because there is still global growth. Demand is still fairly weak. There is supply coming in, so it's because the production cuts. So don't see that really going up above 70. So I don't see the macro really deteriorating too much. Yeah, the question about rate increases which was expected, rate decreases which we expected, I think those are probably deferred now. But I think the ball is now into the on the fiscal side, right? So the budget where you could see some easing from some fiscal stimulus coming in to revive the growth. I think that's what the market is expecting to take us out from this current slowdown what we have seen in the economy.
Okay. You know, talking about that, and you know, it leads me to divestment, because all hopes and eyes are pinned on this big divestment drive. We understand, and that's an ET Now exclusive, that this month itself the BPCL roadshow also would begin. You guys as well are very bullish on this entire PSU cluster. But would you say that the best is behind us, because a lot of these stocks have already rallied? Or do you think the story is yet to play out and even now is a good time to buy in?
If you look at the PSU or the whole basket, I mean the whole PSU enterprises has actually underperformed quite a bit because of the constant supply of paper which was there from the government through the ETF route. And most of the stocks, and these companies are mainly in the core sector, right? Oil and gas sector, the utility space, the metal space, and they are actually to large extent dependent on the domestic economic growth, which has slowed down in the last few quarters, but as I said, these are kind of bottomed out over here. So they'll continue to grow in line with the broader economy. And there, while a few stocks have rallied where there have been talks about strategic disinvestment, but the broader PSU basket is still at quoting at levels at P multiples or price to book value multiples or any other parameter you look at, which are like 10-year lows. Right, so the valuations, and there's not been much change in the earnings outlook. It's a P re-rating.
But are there opportunities outside BPCL and Concor which seem to be the most sought after?
So it's not necessarily one is trying to play the strategic divestment sale. I think what will happen is if you see success in one of these two names, I think the broader pack itself will get re-rated a bit. And that's what I think we are betting on, that the earnings outlook has not really changed. The P multiples have derated. So if you see strategic and probability of more strategic sale happening will lead to some re-rating. Even if that doesn't happen, the dividend yield in some of these companies is fairly good. The government has now gone after these companies and trying to ask them for a larger payout, which is good in terms of capital allocation, right? Because earlier these companies sit on cash and they used to misallocate capital, which is not likely to happen. And that means that dividend yield in some of the names are like 5, 6, 7%, which is almost close to your bond yield. And whatever nominal growth you get because of the overall GDP growth will mean that these companies would give you fairly reasonable returns with very good downside protection. The margin of safety is very good in some of these names.
Manish, we always have seen in the market that every decade calls for a trend. If you bought into IT and pharma, you really hit a home run into the 2000s. All you had to do is just buy IT pharma. If the prefix was software or if the suffix was software, you've hit a home run. Similarly, in last 10 years, if you bought anything which has got to do with consumers or private banking, you've made good returns. Law of averages kick in. You know, in markets they say mean reversion is the biggest truism. So where do you think there is chances of subpar returns for next 5 years, and where do you think there are chances of exponential returns?
Okay, that's again very difficult to predict in the near term, but if you take a slightly longer term view, if you look at the financial space, while it has done well, we think it will continue to do well because again, sectors where there is market share gains, companies or particular aspects are gaining market share, I think they'll continue to do well even with the economic growth is not that great. So I think in the banking and financial services sector, the private banks will continue to gain market share while the overall credit growth is still weak at around 8 to 9%. We see them gaining market share and that trend will continue. Over a medium term, I think corporate banks, we see that banks where we've seen management change and they are actually addressing and transforming the bank, getting the right mix in terms of retail and corporate, will continue to see re-rating and that will drive returns because it's not only earnings growth but also P re-rating potential which is there. So that's another trend which will give you a good return. Apart from that, I would say that consumer discretionary, again, while there has been slight slowdown currently, the shift from unorganized to organized is where you'll get market share, right? So the organized players will continue to gain market share and continue to grow at higher than the broader industry, and that trend will continue. It started in the last 1 or 2 years after GST, but that consolidation in that space will drive growth. So that's again a next 5 to 10 year kind of a theme which will give you outsized return over there. It's not only penetration but also market share gain. And apart from that, I think more from a tactical or a near-term perspective, I would say pharma sector where again earnings valuations bottoming out, the pressure on the US generic space kind of easing off should be able to drive good returns in the near term. These are the broader 2 or 3 themes as we set down which we see will play out over the next couple of years.
Broadly, financials account for 35 to 40% of the index now. That's where the average we're rating it. I'm including insurance also. any reason to believe that the allocation towards financials should be changed? Because 40% is like you're having the heart of the market. And the problem with financials is that insurance and banks have a very different kind of a model. But when they fall together. When they rise together.
So I think there's no doubt that the overall weightage of the financials in the broader market has gone up. But I would look at this way that, see, we are at a stage where the overall economic growth has been weak. We have gone through a large credit cycle. And things over from here, if I take, say, next 2 to 3 year view, will only improve, right? Credit growth is not going to be at around 8% or so. It'll improve from here. The corporate NPA cycle, while we've seen some stress emerging in the mid-corporate cycle, but largely the big corporate cycle is behind us. So given that, I don't see any reason that the overall weightage of the financials in the broader market should come down anytime. And I think while it might not go up significantly from here, I think in a lot of other markets also, if you look at developed markets, financials account for a large part of the benchmark indices. So I think it's still early to say that things have peaked out in the overall banking and financial services sector. And if you look at banking, it's not only banking, right? It's a lot of other financial services. I mean, while NBFCs have seen some kind of pressure, that market share has gone to the banking sector, but insurance and other players are starting to emerge. And I think the opportunity for some of these sectors where, again, the penetration levels are still low, large roadway in terms of growth, I think the sector will continue to dominate, I think, the overall market for quite some time.
Okay, Mahesh, great to have you in the studio. Thank you so much for taking the time and joining in today. Quick status check on what the market is up to. We've gone soft. More importantly, the breath has turned in favor of the negatives.